Hello, everybody. Happy New Year. Welcome to 2023. I'm Michael Smith, and joining me today is Kevin Lenox. And I couldn't think of a better person to kick off the year, especially getting, and you know what, good riddance to 2022. I think many of us will be happy to, see that in the rear view. But 2023, it's going to have its challenges. I think a lot of things could be different. But I thought, you know what, Kevin, let's just kind of maybe kick off. I mean, the ever-changing narrative, right? I mean, We've gone from, the pandemic to the reopening to the inflation to what the recovery, and it just seems like it's a constant changing narrative. And I think that is probably one theme that many of us in the past, if you look over the last 2 decades, the narrative really didn't shift that fast. But now, with considering everything that we have and the money printing, everything we've gone through, I think we're probably in the next decade, if not longer, where things can change on a dime. And here recently, I think the most recent one is we kind of had this nice risk-on trade from the beginning of the year till the other day, when Bullard, which is one of the Fed governors, kind of came out and spoke and said, well, we're going to let rates go to 5 and maybe beyond. So the markets didn't like that. But this is the pace that we're probably going to see. And it really comes down to is you got to be on top of things and do your homework. But what do you think some of the challenges are and some of the narratives may be going forward?
Well, last time we talked about the need to be tactical and smart and have a real investment process.
Correct.
And I think that is going to continue to dominate. I think there are still like two camps of investors. One that just did the 60-40 and for over decades. That worked fine. And then there's the other that keeps flipping their portfolio based on these changing narratives.
Yes.
And I just think that camp of investor is just going to continue to get destroyed in this environment. To move your retirement funds or to advise someone to move retirement funds based on a 6-month view of the market is destined for failure.
So by the time you change it, it's going to be lagging whatever indicated that, right? So you're going to position yourself for the opposite of what could have happened.
Exactly. And based on these changing narratives now, we've had, since all this started last year, 8 bear market rallies.
Yes. That's pretty impactful.
The last one that just started, at the end of December was like 6%.
Mm-hmm.
And the CPI report came out, and all of a sudden, everything's different now.
Yeah.
And cyclical stocks vastly outperforming defensives, high yield is back.
Yep.
Everything is good. And it's like, inflation is beaten. And Warren Buffett once said in the 70s that beating inflation is kind of like trying to lose 20 pounds. The first 10 pounds is like a massage, easy. Second 10 pounds is like a root canal.
Yeah.
And the risk is if the Fed and Jay Powell are going to give up too soon. Punt and let inflation lay dormant, not kill it like they really need to. And then it stays and then becomes more broad-based and much more difficult to quell.
Well, that's actually a good segue, and maybe kind of give us an idea, the Fed's role for the last 2 decades. I mean, you call it the Fed put, and one of the things we talked about on the show is if you think about it, the Fed has been accommodative. I remember in 2019, the stock market, if it declined 2%, you had Janet Yellen, you had every Fed chairman person out there, Jerome Powell, coming out there just to kind of reassure you things were okay. Then the market would rally, right? Mm-hmm. But I think we're now changing that. That is basically something of the past. And if you look at the Fed now, and I think you kind of indicated, is they're trying to balance this, dual mandate and get things right. But tell me, what do you think of the Fed's role and kind of what is some of the things they got to do here in 2023?
So the Fed really since 1987 and Greenspan, that was the crash of 87, is maintaining or supporting the wealth effect. And we wound up with, an economy where the population was stagnating and productivity has been stagnating in recent years. So how do you generate global economic growth? Increase debt.
Yeah.
And then how do you make it sustainable? You make the cost of that debt artificially low. And that's how we've been juicing that. And you add risk to the economic system when you do that. So they've been uber supportive of the economy, providing the Fed put, as you mentioned. And now with things reversing, we had the pandemic, and we just had a tidal wave of stimulus and spending more debt, and now it's difficult to deal with.
Well, you talk about the wealth effect, right? And so just defining that, when you mentioned the Fed's basically driving cost of, of debt lower, which encourages more debt, right? And then that drives asset prices, real estate, stocks, all these things higher. So the wealth effect is you and I, if we have assets on balance sheet that have gone up, we feel, wealthier, right? And we go out and spend more money. So that's what they've been doing. But ultimately now that seems to be somewhat reversing. And the Fed has kind of shifted that. They don't really care about our balance sheet as much anymore. They're shifting their narrative back to inflation.
Yeah, as they have to. And the problem is you had, the unicorn stocks and the meme stocks and all that
Yes.
relied on perpetual refinancing at very low rates. That is gone. And, over 5% of, I think, global companies now are zombies, which means EBIT, earnings before interest and taxes, doesn't fully cover the interest expense. So the biggest risk that's out there, and that's where the Fed's got to try to the needle. They have to address inflation, but there's more debt than can be repaid. So they have to sort of tighten things. Mm-hmm. And I would agree they'll probably go up to about 5%.
Okay.
But then they need to hold it because the Fed funds rate is higher than the 2-year Treasury. Not just 2-year versus 10-year, which is almost 75 basis points. Now, if those 3/4 of 1%, the 2-year is higher than the 10-year, which when it's been like that since July, that's almost a guarantee of recession. Now when you have the 3-month and the Fed funds rate above the 2-year, that means the Fed is overcooked the steak, and we're going to have to deal with that.
Well, and that's what the markets did not like about Fed Governor Bullard. He did come out and say, we're going to go beyond 5, and his suggestion was hold it there for the rest of the year. That was his comment. So the markets heard, wait a second, no pause, well, maybe a pause, but no pivot, no reverse. Mm-hmm. And I think the narrative has been, well, the Fed's going to go, and ultimately at some point they're going to reverse this. And that kind of got squashed, at least by Bullard yesterday. I mean, again, never have I seen where it used to be one unified voice, Fed chairman. Now you got so many different governors coming out and giving their opinions. It can confuse the markets to some degree, but what do you think on his comments? Yeah,
Fed speak has gone just over the top. They're all giving a speech every day, and it's just too much. And it's not like their forecasts have really been accurate either.
Exactly.
But I would agree. They need to get up probably close to 5% and hold, because it takes 6 months, 12 months, maybe longer for any rate hikes or decreases to fully filter through the economy. So there's a real risk that based on what they've already done, we're going to go into recession. But the labor market is still strong. As we talked about before, we had about 2.6 million people leave the workforce. And although the number of full-time jobs has stayed steady, which is helpful, it's like that next person taking those jobs, which has mostly been early retirees, or we're seeing outsized rates now. Exxon and other companies now. So higher wages on top of probably, I would argue, a higher trend in commodity prices because there's been a lack of investment for decades, puts a structurally higher floor for inflation than we've had before.
Well, let's talk a little.
That's going to be difficult to deal with.
So let's talk about inflation. So right now, you've definitely seen CPI came down, which was a good sign. I think many people got probably a little bit too excited. But what are the one things? I mean, commodity prices are coming down. If you look at NFIB surveys, National Federation of Independent Business, you look at some of these ISM, it seems that prices should come down. But what could change that? What is the one thing that maybe could alter that, or do you see anything that could alter that?
The big shift in narrative recently, and we're always having them now,
exactly,
is the reopening of China.
Exactly.
From zero COVID to reopening of China and potentially a massive increase in demand for oil. So OPEC is now thinking that there could be a 1.9 million barrel a day increase in demand for oil, which would take it to just under almost 102 million barrels globally. And where's that going to come from?
Exactly.
And so, U.S. shale has been flat production-wise for the last 6 months, so it doesn't seem like there's room to move notably higher there. Russia, if anything, is probably going to start to produce a little less. They don't have the access to U.S. technology. Venezuela. I know Chevron just had a shipment here recently.
No one's really moving the needle, basically.
Those big fields are compromised, and it will take billions of dollars and years to get Venezuela up to a point to where it moves the needle at all.
But even before that, policy is not there. We know policy has been against energy exploration. Anything that's been proposed is not even going to move the needle. It's not getting anyone excited to go out there or give them the confidence to go out there and start producing. So we're probably going to be in this for a while.
And I follow energy really close, as you know. Maybe at times you get too close to it, but my sense is that there's a fundamental sense that oil prices can move higher there, which would make those CPI numbers more problematic. We'll have the base effects of year over year, which is going to start to look good. We might even, some friend of mine is calling for a negative print in CPI, but it doesn't help the day-to-day cost of living.
Exactly.
For people. Those costs already went up.
But while we're seeing this, the CPI numbers come down, the China reopening, just if you think about it, by the time we see that data really affecting or coming into the inflation price, that's about the time where, in theory, the Fed is either going to hold the line and pause. So all that's going to kind of converge here, right? Yeah. So it's going to be very interesting. And if I just look at the past, anytime you expect something to work perfect in regards to policy, it doesn't. They couldn't hit the side of a barn if they're trying to shoot at something. So I would expect that, we don't know enough data yet, but I would expect probably the narrative now is not going to be the narrative we see once this converges.
It's going to continue shifting, and I think this volatility continues. And the Fed is data dependent. All of us have become data dependent, and I just think it's more important than ever, and it's saved me a few times over the last year and a half where I felt I kind of wanted to make a change and just I had this process. I was like, have it really changed? Does it all line up? And the answer is no, not quite. Then sit on your hands and don't make the trade, because this is how, in bear markets, the rallies and the fallbacks,
they
bulls
suck
get
you
hurt,
in.
bears get hurt,
Yeah.
And it's so important to have a process and not try to change with the narrative, because you're likely going to get whipsawed again this year.
Well, Kevin, you speak of data dependent, and I've been excited about having you on the show. I got to ask you, the Fed's created the new core inflation index, and anytime the Fed comes out and creates a new way or a new index of looking at things, I don't know. To me, it just seems a little bit fishy. But what do you think about that? Is that just a way of covering up inflation, or is there something else I'm missing?
Your intuition is correct. Every time they rejigger inflation statistics, it's always to produce a lower level of inflation.
Yeah.
It's core. It used to be, in CPI, and then it was, excluding energy and food prices because they're volatile. And now they're saying, we need to take the shelter part out as well.
Yeah, no homes.
Which is a third of services. And because that's a lagging indicator. So, we don't really want to just look at that. But more the sticky type inflation data suggests that, again, we're settling at a higher floor. Yes, the edge is coming off of inflation. I mean, you can't just stay there at 8-9%.
Yeah.
So it's coming down. They will continue to politicize inflation numbers and put a nice little bow on it to make it look like it's getting better. But you look at interest rates. The decline in the 10-year from 4.3, 4.4, I think in October, to now 3.4. Yay! Interest rates are coming down. That's good. Mortgage rates are coming down. That's all good. That supports stocks. Okay. But what does the 1 full percent decrease in the Treasury yield, what does that mean? Why is that happening?
Exactly.
And the biggest concern that I have is that we do get into a recession, and it includes the typical default cycle.
Okay. Maybe define what that means.
It means when companies can't.
The zombie companies you mentioned.
Zombie companies get rolled up, they become extinct, and then that exacerbates the unemployment issue. But you've had, over the last few years, just a torrent of money going into leverage loans and private credit and some different real estate type of ventures that we call them non-bank companies, shadow banking.
Okay, yeah.
Which these are markets, and a lot of times that the big banks have exited from, and it's been filled by other publicly traded, oftentimes financial intermediaries that aren't subject to the regulatory constraints of the big banks. So if we get to that, these leverage loans, and you're familiar with this, then so many of them have been written with very low covenants. Mm-hmm. In other words, if the economy starts to stall, if there's a problem fundamentally, then these actions are put into place to protect the debt holders.
So basically junk.
Yeah. And with leveraged loans, and you don't have the collateral, and you're the last in line. And then that of course, would lead to a wave of redemptions. And a lot of people, the biggest standout to me from the Christmas parties and the holiday parties, I always pay attention to what people talk about. And because I'm in this business, then I'll get certain ones.
They're talking about yields again.
Yields again. What I didn't get, and I was really thankful because it's been several years, nothing about crypto.
Oh, yeah.
Or FTX or Bitcoin, not one.
No, they throw the punch on you if you talk about crypto these days.
Yeah. So what I did hear about was, wow, what a bad year in the market. Mm-hmm. But thank goodness my private investments did well. They were almost a positive.
Yeah.
It's like, yeah, they've managed it really well. And I just kind of smiled and didn't say anything. But a lot of these private investments are not marked at the proper valuation. And it's not going to get exposed unless we get into a default cycle.
Sure.
And then the redemptions force the sale of securities, which then force these entities to mark their books appropriately. And then if you've done that and clients see it on their books, mm-hmm. their statements, then it's like, oh. And then the second phase of that then is, maybe I need to change my allocation on my publicly traded securities.
And this is why
that's the risk that's out there, and I know the Fed knows this.
Yeah, oh yeah.
But there's not a regulatory regime about a big part of the financial economy.
But this is why, going back to doing homework, I mean, I've heard people talk about the same thing, looking at leverage ratios, right? Looking at loan to coverage, all these things. I mean, you got to do your homework with anything else, even these type of investments, is understanding how much leverage is in there. And to your point, if it goes the reverse, that can unwind things pretty quickly. So,
and you look at, for example, within the financial sector, just mm-hmm. XLF is the whole sector, but there's such a diverse pattern of returns based on different business models. Yeah. So it's almost like there's kind of two Americas right now. There's the 50-something% that live paycheck to paycheck mm-hmm. with the 20% credit card debt.
Yeah.
And those subprime lenders like Capital One and Ally Bank, well, those stocks are down 25-30%. They're feeling the full weight
sure.
of subprime, whereas American Express is down like 8%. And the average credit score, I think, at the big banks is around 720. So going into and being more tactical, as we talked about the last time, I think is going to be ever more important. Doing the homework, understanding the exposures.
Sure.
And that also tells you then when you're likely to see a recovery.
And it sounds like more quality emphasis on not only just the stocks, but I mean on the fixed income side. Again, you don't want to be in a vehicle like, wow, look at this yield. Well, why does it produce that yield? I remember years ago, someone came in here and they were bragging about, they were getting a pretty high percent, pretty high over the Treasury. And when we looked through it, actually Luke and I looked through it, it was a bunch of Puerto Rican debt. And we know what happened there, right? So you got to be careful just because something has a nice little shiny yield, and people are finally chasing yield again because the markets are now generating that. But that's also could be a trap, and I can see many people making that same mistake over and over. So you got to be careful.
With high yield, I mean, we've had, number one, I mean, with after the pandemic, the flood of stimulus and the PPP and all of that, then despite the economy slowing down, we haven't seen the blowout in high yield spreads yet. It's looked like a safe haven. The duration is a little bit shorter, so it's a little bit less sensitive by nature than investment grade bonds. But on top of that, there isn't the problem sector within high yield. There's always been an overweight to energy, which is typically very economically mm-hmm. sensitive, and energy's been doing great. So people have been looking at high yield and go, it's fine this time. They're better structured, and they did raise a lot of money when interest rates were at rock bottom lows. They raised a lot of money and they extended the maturities, which helped. That was a smart thing to do. But it's like extending the time period before you do have to refinance and you do face the pain. And individuals were able to refi their mortgages at very low rates. And so I think for those reasons, we've had less sensitivity to a big, sharp increase in interest rates and borrowing costs. Let's let the Fed go to 4.5% now, which I know a lot of people in the business are saying could never get to 4.5% without killing the economy.
No.
Yeah, we did, and I think that's the reason why, but there's still going to be a price to be paid. And when there's the eventual conflict between inflationary pressures, principally if commodity prices, particularly oil, go up, and the labor market starts to falter, and those two mandates from the Fed are in conflict, what will they choose to do?
So, Kevin, final question, and I know we're going to be doing many shows this year, so we'll be keeping people informed and everything. But right now, what would you say to an investor, kind of thinking between now and mid-year? What advice would you give as far as laying out your approach or laying out the investment theme? What would you tell someone to do right now? What would you focus on?
Have a process, number one.
Yeah.
It's better to have even a mediocre process than not have one at all.
So having a financial plan that helps you lead to investment-based decisions.
The financial plan, I became a CFP long after I became a CFA, but showing somebody their financial plan and in a year like last year saying, you can still do whatever you want to do.
Exactly.
And it's not going to affect your life.
That is a very strong statement.
But it lowers the blood pressure in the room instantly. I always lead with the financial plan.
Absolutely.
A review of that first and foremost. But I still think, pay attention to quality first.
Okay.
Across the board, and don't get whipsawed by these nuances.
Don't get too excited about a narrative change as that can shift.
Yeah, I mean, already the one that just started this year is already.
Yeah. 2 weeks in. Adios. Well, good. Well, look, I appreciate you coming on. I know we're going to have many conversations, and it seems like there's going to be a lot of data to mine through. It's going to be volatile, but at the same time, we'll help everybody through it. So thanks for coming on.
Sure.